Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? I hope you check us out, jazzwealth.com. Actually, we're financial advisors. We manage our own portfolios. They have zero expense ratios, any kind of fees built into the portfolios at all. We do planning for you. We do weekly classes. We share the research with you and actually building some really cool research tools that you guys can use for those of you that really like to look at your numbers there. Speaking of numbers, we're going to talk about tax loss harvesting today. Do you know what that is? It's kind of like a calculator. Most people don't learn certain math, or English apparently. Most people will not learn different types of math equations because there's calculators that'll do it. When it comes to tax loss harvesting, a lot of times it's just built into whatever you're using, whatever company or program you're there using, but there's a few extra things you can do with it, and everybody's individually unique. So today I want to share an exact account with you, one of our customers here, to show you how we do things and what it all means. All right, tax loss harvesting is basically the effect of taking losing positions inside of a portfolio and using those to offset potential gains or realized gains that you already have. So right now it's December. So let's say that you made a profit of some amount throughout the year in your investing account or your trading account, whatever it is that you have. And you want to offset those. You don't want to pay taxes. Well, you can sell any amount of losing positions to offset capital gains. And in fact, you can actually go into the negative and report as much as a $3,000 capital loss on your taxes. If you happen to have more than a $3,000 capital loss, you can carry forward the additional dollars. So for example, at least as of now, if you had $6,000 in capital losses, the IRS would allow you to write off $3,000 of it this year, and then they would save the other $3,000 and let you use it next year. Well, what happens with us is over the year, we're adjusting our portfolios. We manage our own portfolios so we can actually make adjustments to your account based on what's best for you instead of just saying, oh, well, what's good for you is good for everybody. So what happens is we get dividends, we get interest. We had a lot of buyouts and mergers this year, and that creates different taxable events. Well, it's almost the end of the year, and I don't want my customers to pay tax if they don't have to. So here's an example of what we would do to help. So what you're going to see is a whole lot of gobbledygook. Stick with me for a second. What you really want to look at is this customer currently has $2,099 in capital gains for the year. These are short-term capital gains. This is going to be from our adjustments, right? The account value happens to be just over $800,000, so it's little adjustments that we've done, right? When we moved from one position to the other, or we sold off part of a position to rebalance, well, that amounted to $2,099 in short-term gains. If I were to sell everything in this customer's account today, they would roughly have, does it say? They'd have $126,000 in capital gains. So we're definitely not going to sell everything in their account, not a chance. They've done well this year, and we want to keep it that way. So $713,000 plus $126,000, that's where they're at. Now, they have positions in their account that are doing poorly. We actually have 665 positions inside of this account, and so naturally not all of them are going to do well. I'll bet you Energy or some of them in there, maybe some REITs. And so all I really want to do is eliminate this up here. I want to let all this stay the same. They have $126,000 profit. I don't want the IRS to know about that. They've got $13,000 in losses. I don't need to sell all that because we're just trying to offset $2,000, and if the customer wants, maybe we'll go down to the $3,000 capital loss. But here's how you do this. Here's one way to do this. You know what the wash sale is, right? We've done a video on this maybe somewhere. The wash sale says, hey, you can't just sell a losing position so that the brokerage firm reports it as a losing position, then just turn around and buy it back again and wait till next year, and now you have a loss. If you do that, the loss is washed away. You can use it to offset future capital gains, but you're not allowed to take that loss for that calendar year. What they ask you to do is, let's say you owned Apple and you have a loss. You can sell it for the loss, but you can't go back and buy it for 30 days. You have to sit and wait. Now, you could buy something else. You could go buy gold, for example. It's not somewhat equal or substantially identical, is the key word there, to Apple. What you couldn't do is buy Apple, sell it for a loss, then just turn around and buy something highly correlated to it, like maybe Google or Amazon or something. I don't know. So you got to be careful there. Now, this customer said, If you do want to erase my capital gains, number one, I ask that you do it with the least amount being out of the market as possible. So we're not just going to blindly sell off losing positions. Number two, he says, I'm okay with it sitting in cash for the 30 days because we don't have anywhere else to go. We invest in our positions and that's it. So my mission here is to erase the $2,099 with using as little of their $800,000 as possible. What you're seeing on the screen is this is showing me if at any one point that I click here, for example, like let's say I click right here on this guy, it's saying you sell off $200,000 and have a $40,000 capital gain. You can also go over here and see that it's about $200,000 that we would sell, and it would result in a $40,000, $500 capital gain. We don't want that. That's a big capital gain. We can't do that for this customer. He said sell as little as possible to erase the $2,099. Actually, it was my idea, but it was what we do. So what I want to do is go over here and see, look, we've got some capital losses, these positions in here. What I want to do is say, well, what's the least amount that I can sell to offset that? I can sell $2,635 and we would have a $1,600 capital loss. Not going to work. We need to go a little bit more. So what I'm going to do is I'm going to go down. Right? So now I'm going to just try to go down a little bit more right there. I'm not going to zoom in so it doesn't mess up your screen, but here we go. One little click there. We've got a capital loss of $2,120 by selling only the notional value of $65.89. So he's got $800,000. We're going to take $65.89 of it and we're going to sell it. Of that, $2,100 is going to be a capital loss. That'll offset all of his capital gains. And $6,500 is going to sit for 30 days. We're going to put it in a money market fund, but nonetheless, it's going to sit for 30 days. The rest of his $800,000 is free to continue gaining the 100 and whatever he's gained so far this year. So we're taking a very, very tiny bit to step out of the market, realize a capital loss, follow the rules, wait the 30 days, and then we'll put it back in the exact same positions, hopefully at a lower price. Now, most people, what they would do is just say, I've got $2,099 in capital gains to offset. I'll just go find some position that has a $2,000 loss. Imagine the size of that position if you were to do that, right? You might invest $100,000 and have a 2% loss and you sell that. Now that's $100,000 that can't go grow anymore. So we don't want to do that. In this case, we're being almost as efficient as possible. We are going to sell $6,500 to have a $2,100 capital loss. I'm going to set the orders up and get everything going. I'm not going to click this button because this will show the person's name and everything. But now what the system will do is say, okay, we can make that happen. Here is how we will put those orders together, figures out exactly what to do. We'll have the most efficient capital loss that we can do there. Now, customer goes into the new year. They get their tax form 1099 from this account here. It's a brokerage account, and it's not going to show anything. It's going to show a couple dollars in a capital loss there that they get to go on. Let's do one more thing while we're here because I'm having fun. Let's say the customer said, I want to have a $3,000 capital loss. I'll go ahead and take that loss. I have income or something I need to offset, so let's do that. So in this case, we want to use the least amount of money to offset $5,000. We want to eliminate this plus an additional 3. I'm just rounding. So what we're going to do is come over here and take a look and see what we can do. So we really don't, I'm not going to zoom in again because it'll mess up your screen, but this just proves we could have sold less than the $3,000 before. Nonetheless, we're going to sell $5,200 off of positions here, which is pretty cool, to get a $5,300 capital loss. So we're going to end up with $5,271. We'll have on paper $5,329. That's what that's saying there. On paper, this number will go 3,000 lower, or 2,000 lower plus the 3,000. So for a total of $5,329, that eliminates his capital gains and gives him a $3,000 capital loss. I like it. So if that's what the customer wanted to do, we could do that as well. Pretty cool, huh? So tax loss harvesting is more than just saying, well, it's automated, man. It is. We can automate this, but take a look and see, is there any one way to make it more efficient so that you can keep using the rest of your dollars? Hope that helps. If it helped you, hit the subscribe button. Check us out at jazzwealth.com. All the good stuff that we're here to do, because these marketing videos is why I wear the shirt every day. Really, every day, everywhere.